and we're on the daily chart. And we have this macro premium discount that I always pay attention to. So you can see this would be the macro scale of determining the premium range up here and the discount range down here. And you can see the price already came down into this discount range here on Tuesday, and then we had this expansion up. So that's how you know when it leaves one area to the next. Now, what happened here is that it actually left equal highs, which definitely leads to believe that it's going to come back for those, and you just don't know when. So moving down to the 4 hour, I want to show you more of a micro premium discount range. So this is more of the daily range down here to up here. But now you can see we've created this new range, which that would be the micro range. With your GAN box here, you have the 50% mark of the micro range right in here. So now that we've marked our 50%, you can see prices come down again and tapped it. So the point I'm trying to make here is a lot of traders try to get in after sweeps of liquidity that are really weak, and they wonder why they get stopped out. They say, oh, well, this is a daily previous high. It's a daily previous low. Price should reverse here. And let me show you why it's not. And it's basically based on two things: where you are in the premium and where you are in the discount. What has happened? Like in this case here, we've expanded up, and now you can see that we're coming down into today. Here's today right here. And let's move down to the 1 minute, and I'll show you why you're getting faked out on trades like the daily previous low, weekly previous low, etc. So here on the 1 hour, before we go to the 1 minute, I want to show you something, how prices come into this premium, okay, or into this discount zone here on the micro range. You noticed one thing over to the left. There is no real valid external sweep of liquidity or major swing low sweep of liquidity that happened here. And that's part of the problem. Here we are on the 1 minute. You can see that the expansion came to the top, left at equal highs. You could say that expansion is now exhausted. And in this example, though, we're going to assume that the expansion up is over, left at equal highs. Okay, just for the example's sake. So now that we're coming down like this, the trends had shifted. Now, this here is the daily previous low, right in here. And what's happened here is price has taken it, all right? And a lot of people say, all right, you know, we have a sweep of liquidity here. The daily previous low has been taken. Let's get into a unicorn model, and let's have a look what happens. So here we have the sweep. Price comes up, and here we have price displacing over this breaker block here. So your entry would actually be on this fair value gap in here. Price taps into it. It doesn't give you very much drawdown. Your stop loss would be, see, in this case, you don't need to put it to the low of the range. It's the best place to be, but it doesn't need to be. It needs to be, do you see this breakaway candle? This is the candle that displaced here over that breaker. Your stop loss is safe below that candle right there. And just to make it safe, one more down, okay? Or you can do 2 points off of the wick of the candle. In this case, just bring it here. Now, if it comes down and taps this order block right here, like it did right here, almost, not quite, you're safe. So what happened here is you think you're getting into a really good trade, and you see those equal highs up there, and you think it's going for those equal highs. Okay? Now, this thing falls pretty short for two reasons. This low here that you're calling the daily previous low, if it was on trend, I'd be all about this right here. Okay? Now, you also need a bias before you get into this trade, which is, your fair value gap bias. And I've covered that in my last video. I don't want to get into it right now. And maybe even there is not a strong enough bias to get into this trade, but I'm just showing examples of expansion and exhaustion of expansion and trends and why not to bite on stuff like this. So in this trade here, you use a 53-point stop loss. And if you want the first wick high to give you a 1 to 2, it's actually right here. Okay? Now, because this is a counter trend trade, when we closed over these highs right here, you want to move your stop loss in a counter trend trade immediately to the short-term low, which is right here. So you moved your stop loss up and you went to the short-term low here, which is I always stay a point off, which is about an 8-point stop left. we came flat of our 1 to 2, and then it came down and stopped trying to break even. And now, if you had a futures contracts running, you're 100 points in drawdown because of the trailing down draw. And that really sucks. And I'm going to show you how to avoid trades like this. Now, let me give you the main reason, and we'll write them out why you want to avoid this kind of low right here. And I'll give you the reason in order. First of all, you have to know where you're trading. You are trading in a premium zone. You're trading in this premium above these lines here. So number one, you're trading in a premium. Number two, the trends are down. So you have a downtrend in a premium. And when you're in a downtrend, which would be a counter trend trade, you want external highs and major pivot swing lows on at least the 1 hour to the 4 hour before you can get into a counter trend trade. Now, I gave you the first reason was the premium. The second reason is the trends are down. So it's actually a counter trend in the premium. And you want to avoid those trades unless an external high has been taken. So for example, if price came up and took these external highs up here, do you see how these are equal highs, external highs right here? You would be in the premium still, correct? And it would be counter trend. So this is the only circumstance where you want to take a counter trend trade in the premium zone, even the micro premium, right? This is the expansion up. So you would take the sell because now it's called exhaustion. The expansion move has potentially come to exhaustion, right? And you can see that this is the downward movement heading towards the discount where smart money is going to buy. So taking buys on this leg here is where you're going to get absolutely worked. I'm just saving you tons and tons of stop outs here for like absolutely no reason that you need to be taking these trades. So I hope that makes sense. I'm going to repeat myself. You need to know if you're in the expansion stage on the way up, right? So in this case here, if you're buying in a premium, which you can still do, like buying in a premium is fine because you're in the expansion stage up. So it comes up, the trends are up, so you're buying, you're sweeping these minor sell side liquidity, you're going up with the trend. And as soon as you see anything getting taken out, like a daily previous high or an extreme or a weekly previous high or equal highs or these external highs, then you call the expansion exhausted. Okay? So then you refrain from taking any more buys in a premium zone. An external gets swept and or a return to the discount. That means the price has finished its job in the premium. It needs to come down to a discount now to rebalance the books. And people say that ICT concepts it's not how the orders are booked. They're completely wrong. This happens constantly. There is no denying it. The people that are on Instagram, the people who are talking shit about ICT, they can talk shit all they want. They don't understand it. Okay? They don't understand any of this. Price is just filling in balances in the premium, coming down, filling in balances in the discount. As you can see here, that's exactly what it did over here. You had this low here, that high right here. Price took the high out. It expanded up here. Follow my mouse. This was the expansion stage. Price came down, took the highs out. It's finished its job now in the premium, okay? It needs to come down to a discount in this fair value gap down in here, right? So grabbed an all-time high. This is the expansion. Took it. It's exhausted. The premium is now exhausted. You don't start looking for buys right here, okay? You don't. There's no buys in here, and I bet you get faked out a million times in here. There's no buys anymore. Let me quickly show you. This is how I determine the trends. I use the 15-minute, the 30-minute, and the 1 hour, and I use a 200 EMA. Here's a 50, here's a 20, but disregard that just for right now. You can see in the time of our trade, we slipped below the 200 on the 15-minute. That's bearish below it and bullish above it. So we're below it, and I need 2 out of 3 confirmations. The 15-minute, the 30-minute, and the 1 hour. As soon as I get 2 out of 3, that's the actual trend. 30-minute. In the time of getting into this trade, you can see trade was down here. where my mouse cursor is, we're below the 200. There's our 2 out of 3. We'll go to the 1 hour just to have a peek, and we're also below. So these are called micro trends because the 200 is just a tool. So it's a tool we use to determine the trends. As you look on the 1 hour, you can see it makes way more sense. You can see that prices come up, right? It needs to come back into a discount right here. It did. So looking for buys until it comes into the appropriate area is key. All right. Looking for the wrong sweep of liquidity when price may be exhausted. It's expansion. Don't look for buys. Don't take counter trend trades in a premium if it's exhausted. And in this case, exhaustion could either be it didn't take the highs, but now all it's doing is returning to the discount of the new leg that was created over here. And that's exactly what it did. So what we're going to do is we're going to combine this knowledge of premium, discount, expansion, exhaustion, and the trends, and that will determine whether or not you take the unicorn model. That will determine whether or not you're going to continue. In this case, you want to take a continuation model with the trends. And I'll be teaching my continuation model more and more and more. And it uses these EMAs here. And I don't give a shit what ICT traders say about EMAs. This absolutely fucking kills it. And I'm using smart money and imbalances to get in to my trades on the micro premiums and the micro discounts, which I will show you. So it's very a simple concept here, right? When the premium is exhausted, you don't want to take buys anymore. Exhausted is taking out external highs, right? You want to return to a discount. Redistribution, if you don't have a proper sweep, you wait for redistribution. So that's good. Have a good weekend, guys. We absolutely killed it this week, and we'll be back on the charts next week, and we'll see you then.